Panirka method.
Ashu, Prakash Mishra sir, please make him the
co-host. Somebody is trying to use the annotate function. Please remove those lines from the presentation. Whoever has used, please use the eraser and remove them. Bhave sir, or else you have to remove the presentation and then present it again. Share the screen again. संदीप, ये स्क्रीन को दोबारा रिमूव करके दोबारा डालिए, क्योंकि इस पे किसी ने लाइन मार दिया ऐसे एनोटेट करके.
चलो
ठीक है, हो गया.
हाँ, बस आप 2 मिनट में ज्वाइन. हेलो भावे जी. हेलो. अरे क्या हुआ? हेलो भावे सर, नहीं है लाइन पे?
हाँ बोलो संदीप जी.
अरे वो दीपा जी ज्वाइन कर गई, आप बोलो फिर उनके लिए. फिर कुछ दीपा जी को ज्वाइन करा दिया उनको.
ज्वाइन किया है?
हाँ किया है.
ओके. आशु, दीपा जी को होस्ट बनाओ.
सर ऑलरेडी
हाँ
डन.
बनाया, वेरी गुड. दीपा जी वेलकम.
All right.
All right. So shall we start? It's already 6:30.
Fine. Fair enough.
Yeah, we can start.
So yeah, Deepa ji, welcome, and it's my privilege
Who's speaking?
to invite all of you.
Bhaviji, namaste.
हाँ दीपा जी वेलकम. ऑस्ट्रेलिया में ठंडी है क्या?
बहुत ज़्यादा ठंडा है.
Good. All right, so we are getting started, Deepaji, and
जी.
thank you. And I suppose Ankit ji has also joined. Sandeep ji.
Yes, Ankit ji has joined.
Okay.
Very much, Bhaviji.
Yeah, Ankit ji,
Good
welcome.
evening. Good
I
evening.
mean, you are full of books as usual behind. Kab padhte ho, Bhagwan jane. Okay. As on behalf of Association of Valuation Professionals, it is my pleasure to welcome all of you, and it's a pleasure that 60 people have already joined, and
Yes.
there is a huge rush. So I'm sure in some time we will be at a conclusion level of 100, and then we have a YouTube streaming. Having said that, on a contemporary topic, I decided that rather the team and myself, professional development, decided that we have to have this topic done. Though our 1 year's plan was ready, we said that since the IVS 2022 is a new one, we must do something very quickly. And in view of that, we said that we need to have some competent and studied personality who on the subject of changes in IVS 2020 versus 22 can deliver. And most of the people then ended up in suggesting Ankitji's name. So there's no question of deciding the speaker when it comes to anything latest. And you can imagine, because his screen behind that, there are so many books that there is a guarantee that any new topic comes, he is always available. And thank you, Ankitji. And we also said that we are talking about international valuation standards, so why not have some international personality? So we ended up in requesting Deepaji. She is from Australia, Melbourne. Of course, originally from India, by heart Indian, but now by caliber global and by global role. So for international valuation standard, nobody other than her could be most competent. This association, just brief in short, is the Association of Valuation Professionals, and life membership is available at 5,000 rupees one time, and that's all. And all over the life, you don't have to pay anything. And we are holding webinars almost every week, and the plan up to June is fixed. But we will be showing you that. Now, since today we have lot of matters to cover, I will open the agenda which we have, so that you will get an idea what we are in for. So Association of Professional Valuers welcomes, it's under formation, it should happen soon. It's a knowledge webinar today, changes in IVS 2020 versus new IVS 2022. Our speaker is Ankit Goyalji, whom my colleagues will introduce, and our chief guest is Deepa Gupta from Australia. She is CA, CS final, LLB, CISA, CPA. And Ankit ji is a famous speaker, more than CA and ID and SFA anyway. Today's agenda is like this, today's brief on AVP and upcoming webinars I'll share quickly. And then we have chief guest Murali Krishnan introduction and address by chief guest Deepa ji. Speaker's introduction by Prakash Mishra ji. Ankit Goyal ji then will be doing the deliberation, and vote of thanks by my colleague Himal Maru. So here is a quick presentation of AVP to give the brief. This program is organized on behalf of Association Valuation Profession under formation and our partners guide and guidance IIV India Registered Valuers Foundation RVO. We are jointly holding this CP hours program. So those who are members, they please declare in their Zoom chat. Speaker, of course, as I said, is Ankit Goyal ji. And I hand over to Aishwarya ji. Aishwarya ji, over to you. Aishwarya ji, are you there?
Yes, sir. Good evening.
Yeah, please take over.
अभी प्रेजेंटेशन ओपन हुआ बाबा जी? अभी presentation has not opened.
Is that okay now?
Yes, yes, okay.
Yeah. Yes, Aishwarya ji, over to you.
I, Aishwarya Garude, welcome you all on behalf of IIV India Registered Valuers Foundation. As you all know, that IIV RVF is recognized by IVBI as Registered Valuers Organization as per the provision of Companies Act. Architect Ilyas Amin Sheikh is the Managing Director of IIV RVF. IIV RVF has been contributing immensely to the enhancement of the valuers through its academic programs and imparting teaching. IIV RVF conducts 50 hours of training CEP programs as for the Registered Valuers Organization for all the class of asset. IIV RVF is to promote and develop the profession of valuers. Over to you, sir. Thank you.
All right. Thank you, Aishwarya ji. Now the interested audience, I welcome you to become life member by paying membership fee of 5,000 only. And this is not restricted to registered valuers. Anybody interested in valuation is welcome to become a member. Okay. What are the milestones we have achieved? Within 6 months, already we have finished 1 or 2 months, and more than 4 CEP programs have been held. Our members are close to 150. They are from foreign countries also, London, Dubai, and Australia. And there are famous personalities like Amit Apte sir, the past president of ICMAI, then ex-chairman of BSc. Then there are famous book authors like Sudhaji. And then there are international certified valuers like Subhaji. And there are prominent speakers also. 6 newsletters have been already published. And the latest one is of 1st September. Issue has been published. You are welcome to go ahead with that and have a look at that. 22 webinars have been already covered. We have free webinars, at least 2 each month. But last 3 months, we have been holding 4 webinars. Then we mentor the newly registered valuers and we mentor the students also. E-newsletter is there for sharing the knowledge. We provide you to get a network in national and international level. Our members are in, I think, 34 cities. And then we are studying various valuation standards to give the suggestions to IBBI. You are welcome to join and participate in the activities of various committees. We have international webinars and they are available to us at discounted price due to our tie-ups with IVS and others. We have formed various study groups. Then we have already 30 days have been planned. So the webinars up to, I think, June or July 2021, the speakers have been fixed and chief guest has been fixed. Then all these programs are under credit hours of CEP program. Here are some of the programs list. Next week, we have fixed asset valuations by engineer Sanjeev Agarwal. I'm sure many of the land and building and plant and machinery people will also be interested. Then 11 UA, Sumit Dhaddaji will be the speaker. Then Sudha Bhushanji, a champion of FEMA, who is our member and vice president also. She will be speaking. Then we have Naveen Khandelwal, our inner faculty, Sanjeev Sejal Agarwal. You can see here value at risk and valuations in Australia. So here is a big list. This presentation is available to you again. And up to 24th June, we have blocked, but you are welcome as a speaker also For any query, over to me at this number, or for membership assistance, Nitin Brahma, and the webinar queries, Sandeep Agarwal. Anytime you are welcome to contact us. Here is the small presentation from my side completed. And now I hand over to my friend Murli Krishnan for introduction of chief guest. Murli ji, over to you.
Yes, sir. Thank you. Thank you, sir. Thank you. So, yeah, good evening, everyone. My name is Murli Krishnan. On behalf of AVP, I welcome you all again to this webinar. And now it's time for us to welcome our chief guest for the day. We have Madam Deepa Jain Gupta joining us as the chief guest. In this new normal where webinars are replacing most seminars, we are lucky to have Madam joining us from Australia. So, Madam, we would like to thank you for honoring us with your presence. Moving on to the description, given the paucity of time, I'm just giving a brief about our numerous participation. So, yeah, it's a short description. Madam is a chartered accountant, lawyer, social activist, and ardent speaker. And then other milestones in her professional journeys in terms of educational qualification includes CS Final, CISA, and then ITAX Australia, and MBA, member CPA Australia. And she has actively contributed to all spheres and has been vociferous on all platforms regarding issues relating to betterment and enhancement of professional upgradation, growth, and qualitative performance. She has over 25 years of experience in various areas in the finance field, spanning across various industries. She has been actively engaged herself as a speaker, writer, and contributor to different forums, including various programs conducted by ICI, budget discussions, and then television interviews in DD, Z Business, etc. And then launch of book on Make in India, and then Make in India Window to Success. Speaker in various meetings on topic of Make in India. And then other meetings include various legal concepts, smart cities, pollution mitigation, etc. So as we can see, she has wider, she has covered a wider, areas of, wider areas actually. So, and her contribution and participation runs into pages. So I have cut short here, and there are other responsibilities she has taken over and above this being a speaker and writer. So those include India coordinator for Indo-European Business Forum, and then member of advisory forum, Fertilizer Association of India, and then nominated as jury member in Indian Chamber of Commerce. This honor has been bestowed consecutively for 4 years. So, and then she has acted as arbitrator for various bodies. And then she was a board member of ICSACA, and also acted as coordinator for 3 years. And she has also actively participated in various committees of ICA. And then she has also been the leader of high-powered business delegation as part of Indo-Canada Business Council. And then other responsibilities like member of committee on WTO of FICCI, expert committees of ASSOCHAM, South Asia Federation of Accountants, Central Council member of ICMA. So these are few of various responsibilities she has played. And one more thing to notice, she has actively participated in all these things simultaneously. So in her 25 years of professional experience. And then, so yeah, with this description, may I now request our chief guest to address the participants of the webinar. Over to you, ma'am.
Yes, Deepaji, welcome to you. You can unmute and start speaking. Deepaji, unmute, please.
All right. Thank you so much. And I didn't deserve so much of upload or so much of the detail of myself, but it's a pleasure because when I participate with people where back in India, Hamara Desh Mahan hai. So I feel absolutely on top of the world when I am talking about anything relating to coordination of energies and things which are connected to India and connecting them back to the international sector. And also, I would like to share a very beautiful experience what brought me to valuation. भावे जी की क्लास में मैं एक स्टूडेंट बन के गई थी और भावे जी ने इतना बढ़िया तरीके से इम्प्रेस करा, उनका जो एक्सपीरियंस और जो उनका उनका जो जीवन का अनुभव रहा और जिस तरीके से उन्होंने एक्सप्लेन करा, मुझे आज भी बहुत अच्छे से एकदम बात करते हुए बिल्कुल ध्यान आता है कि मैं बिल्कुल जैसे अपने क्लास में 21 साल की उम्र में क्लास में बैठ के टीचर को एकदम स्तब्ध होकर देखती थी, बिल्कुल उसी रूप से मैं भावे जी को सुन रही थी। और भावे जी चौक लेकर, भावे जी सही कह रही हूँ, आप बोर्ड पे लिख रहे थे और आपने बहुत खूबसूरत तरीके से बताया किस तरीके से नोकिया के सेल्स की आप लोगों ने जापान में आपका एक्सपीरियंस रहा, उनसे डिस्कशन करने का और किस तरीके से उन्होंने आपसे एक्शन एक्ट किया, किस तरीके से आपने कंक्लूड करा। और रिलायंस के मैटर को जब आप लोग टीम लीडर बन के लेके गए थे, वो इस तरीके से मेरे दिमाग पे इम्प्रिंट हुआ कि हमने ज्वाइन किया भावे जी को बिल्कुल आई वुड से फ्रॉम माइंड हार्ट एंड सोल। एंड जब भावे जी ने ये ऑर्गेनाइजेशन क्रिएट करने का विचार सामने रखा तो मुझे लगा कि इससे बढ़िया बेहतर बात नहीं हो सकती है, क्योंकि आज ये चैप्टर जो हमने भारत से शुरू किया है, ये एक हमारा परचम लहराएगा जब हम इसको सारे देशों में लेके जा सकेंगे और शायद उसमें ऑस्ट्रेलिया को कि यहाँ इसका परचम फहराने की जिम्मेवारी शायद मेरे ऊपर आएगी, तो मैं बिल्कुल बखूबी से उसको पूरा करने का प्रयास करूंगी। अब ये तो बात कही मैंने कि किस तरीके से आई एम इमोशनली इन्वॉल्व विद APV and how Bhaviji, who's central hub of the whole system, is the जिसे कहते हैं धुरी, he is the central hub of it, and we are all the spikes in the wheel which rotate and which gives energy to any vehicle to be able to bring the force and the movement. Now, coming to the point, which of course I'll not go into much into technicality because it's not my technical session today, but since I'm in Australia, I would put in a couple of points in there. Ever since we had internationally accepted IFRS and the standards internationally accepted, valuation of business, security, and intangible assets came into the bucket with accountants, chartered accountants, and people who are related and wanted to progress and bring more governance in this sector. And as far as Australia is concerned, Accounting Professional Ethical Standard Board here, which is called the APAS 2225, is what governs the valuation and the process of valuation in Australia. And AES2, just like we are talking about the standards there, AES2 New Zealand, which is Independent Business Valuation Engagements, is what actually covers about how we go about business and valuations and the various verticals underneath, which are most important to us. Now, a very big important point, just like we talk about IV 2021 over there in the differences, which probably one of the technical speakers is going to bring. AASP 16 is leasing standard, which was issued in Australia in January 2020. And it had a very important point. Why bring to the fact that it will bring to you that how similarities exist over international borders when we talk about valuations. What are the issues which are common and some of the things which are probably not so common and probably need to become more similar, so that just like other standards, valuations across the borders can also be rated and considered in a similar manner. So a very important point was how operating and financial leases should be adjusted for the pandemic. From last year, we've had pandemic, and that was a very big question because pandemic has brought a whole range of issues. So the very big point which existed here was that different structures lead to different results. And because there was an option of discretion, which led to the fact that possibly I will take one form of it and another would take another form of it. And that would bring a a whole lot of uncertainty. So how would we able to say there is a parity in the valuations? Well, so that's a big question which is still being talked and discussed on bigger forums. And another thing which was very important was the impairment challenges. Now, COVID-19 had a big downturn, and with respondents, they had a belief that a retail sector has not got much impacted, and therefore the impairment challenge should be considered as minimum. And because there has not been much impact on that, and the market risk premium has averaged out the process at its end, so sectoral considerations should dominate the valuations during COVID, and there's not a one vertical which should apply to all. Now, there is little census on different things. And another important thing is valuations here, because the data from where it is taken up to create a valuation it's not so concrete. The valuations here are much too different vis-a-vis when we compare about the valuations which are processed in US and EU. Now, this brings a very important point that we as APV, where we in India, we are trying to, really go in very minute levels. So this could be a very, very big, important area which we all could pop into it and bring in some very important results and flag out the issues so that we are the pioneers on the issue. Because once we know that there are certain gray areas existing in a particular international market, and we can do some technical work and some input on that, then we would be able to flag out as the pioneers. And obviously, we all are professionals looking for money. So who is probably not interested in having money in dollars? I'm sure all of the members here would be more than happy to say, oh yes, why not? Let's go ahead. So bringing this as an input to the people and the members here who are saying, I would say, I would suggest Bhaviji, it would be worthwhile we take a dive into that particular thing next time, and whenever the committees have a little bit of time on that, so that all the members can start having a little bit tip of the iceberg on the international level. And
Please keep yourself mute.
And not taking much of the time. I would say bringing this into the forum. Valuation has a great prospect in Australia. Valuation has a great prospect in Australia, and I think we as a committee could really do a good job about taking it forward. And with this, I leave the coordinator of the seminar to proceed. And we're not taking much of the valuable time. If the members are looking forward to have a more detailed technical discussion, I would appreciate it may be taken over to the next speaker. Thank you so much.
Thank you, Deepaji. It is an honor, and I still remember the day I taught in Delhi, and in the evening I went to some club, if I recollect. I think cricket.
India International Center.
India International Center. That's right. And my memories are still there of a very intelligent discussion. And I knew that someday or the other, we are going to have a great association. And I'm sure you will take this to the not only greater, but global heights also to the Association of Valuation Professionals. And we are all proud that our member is in Melbourne, Australia, and making a great mark there. And already I'm seeing in the chat mode, a lot of kudos have started coming up for you. Now I hand over to Prakash Mishra ji for the introduction of chief guest. Prakash ji.
Yeah, good evening, everybody. I am Prakash Mishra, and I'm here to introduce Mr. Aniket Goyal, who is going to be the next speaker. Mr. Aniket Goyal is a managing partner at AAA Valuation and AAA G and Company.
He is Ankit Goyal, Ankit, not Aniket.
Ankit, yeah. Okay, sorry. He is a practicing chartered accountant and a registered valuer for financial assets. His passionate dedication and commitment to spread and share his knowledge and learning is an important component of empowerment. He is simply amazing and inspiring. He has personally mentored students and professionals alike in almost all the areas of corporate finance valuation one can think of in this profession. He has completed more than 500 audits as a chartered accountant and more than 100 plus valuation. He is actually involved in lectures for almost all the RVOs which we see here and other corporate and regulatory bodies in this profession. Sri Ankit Goel has been actively providing consultancy to corporate on insolvency and bankruptcy law. His merger and acquisition, financial and operation restructuring. Perhaps this is one of the reasons that is always a pleasure to hear him out, because his lecture is always a perfect blend of academic thoughtfulness and rooted to the ground realities faced by the professionals. So it is like as Mr. Bhave had pointed out, it's not only the books, but the ground level experience is also helping him to become the best speaker or renowned speaker on the valuation. So by with this, I pass it on to Mr. Aniket for for his session.
Thank you so much. Thank you, Prakash ji. Thank you, Bhavi sir, once again for inviting me at this forum. A very, very upcoming, very, very, I should say, educative and very, very interesting topics Mr. Bhave chooses for these webinars. And that's what makes it interesting. Today's topic that he has chosen is also very, very interesting. We're talking about changes in IVS, something that affects every valuer who is doing valuation in India. And I'm not saying only registered valuers, this also affects other valuers who are working for banks, where the banks have a very specific requirement that the valuation has to be based on IVS or in compliance with IVS, I should say. So therefore, the changes, we need to review them, we need to look at them, we need to see which of these changes, which of these additions that they have made in IVS impact us. And I will share my presentation and take that forward. I will request all of you to keep your mics muted. And in case you have any question on the slide that I'm talking about, please feel free to talk about it after unmuting yourself. We will be looking forward to have a interactive session. Any questions that you have, those questions can be taken up immediately rather than waiting for the end of the webinar so that we can have an interactive session. So what is the importance of IVS? Now, Rule 8.1 of the Registered Valuers and Valuation Rules makes it very clear that the valuation standards that are required to be followed by any registered valuer has to be as per Rule 18. Unfortunately, Rule 18 talks about valuation standards, but those valuation standards which are for India are yet to be launched or yet to be announced. So there is a proviso. The proviso says that until the valuation standards are notified or modified by the central government, a valuer shall make valuations as per internationally accepted valuation standards, and then it goes on to say valuation standards adopted by any registered valuers organization. Now, most RVOs, apart from a few, have adopted the IVS, the International Valuation Standards, as the standards that they want their valuers to practice. There are also at parallel, there are ICAI valuation standards, but those ICAI valuation standards are one only for securities or financial assets. So therefore, the land and building, plant and machinery part is missing in them. Secondly, they were launched in 2018. So there are now a few changes or few differences between IVS and ICAI valuation standards in terms of compliance that is required to be done. Now, the code of conduct stated in the registered values and valuation rules also makes it clear at point number 7 that a valuer shall carry out professional services in accordance with the relevant technical and professional standards that may be specified from time to time. So you are also required under the code of conduct to follow standards. And of course, there are other valuers who are working for banks, who are working with their own past experience. And wherever the bank says follow IVS when you're giving me the reports, one has to, of course, look at the IVS that is present as on date. Because as we will discuss going forward, in case you are partly following IVS, you're not following IVS at all. That's what IVS says, that you please go ahead and complete and honor the IVS, or make your valuation report, or do the valuation processes based on the IVS. And if one does not do that, in that case, it will become a case where there can be somebody can say that you have not followed the standards at all. Then if you talk about responsibility, it again says that wherever you are doing a valuation and you are maybe, you know, giving some parts of the valuation to be done by some parts of the evaluation you're giving to somebody else, maybe a specialized land and building valuer who is giving the task of valuing land and building by the SFA valuer, and so on. So in that, you know, normally we feel, oh, it doesn't matter. We are getting a specialized opinion. If some responsibility comes in, so if some responsibility comes in. So, Mr. Tupe, in case you're listening, you're repeatedly unmuting yourself. So that is causing disturbance to everyone, and we will have no other option. We will have no other option but to, I think we can. I don't think the unmuting is happening on purpose, so maybe we can take action if that happens again.
Ankit, mute कर दीजिए ना, आपके पास you'll have the option. Sorry,
no,
not you.
I think we are muting. We are muting him, but he's unmuting.
I will remove कर दो Sandeep.
So yeah. I think it's
because
causing
it disturbs the
disturbance.
concentration goes. These are technical issues. We need to concentrate.
So the idea is that when we talk about Rule 8.2 very, very specifically says that in case you are giving the part of your valuation to some expert, say today somebody says, I'm not an expert in power plant valuation, I will have to go to somebody who has that expertise and work with him. And I will include that power plant or that P&M application, the valuation, within my overall company valuation and take the valuation forward. Now that is completely permissible under Rule 8.2. But the idea is that wherever that is done, the responsibility of the evaluation remains with the person who is primarily responsible for the valuation. You can't say that, oh, I appointed an expert and therefore I am not responsible, only he is responsible. So therefore, when that responsibility is looked at, the responsibility also extends to everything, including the following of IVS. Let's understand the possible effects under Companies Act with respect to valuation standards. So when we talk about registered valuers, all registered valuers are doing the valuations under the powers given by Section 247 of the Companies Act 2013. And there the penalty is of 50,000 rupee penalty, and in case of fraud, then it can be a higher penalty or imprisonment also. Then the section very clearly says in Section 247(3) and 4 subsections, it says that one, there might be a requirement for you to refund the remuneration, and lastly, it also says that there might be a requirement for the valuer to pay for damages which have occurred because of the valuer's negligence, ignorance, or not following the standards or other parts of the valuation. Then one can have a cancellation or suspension of registration of valuer under Rule 15. There can be a complaint against registered valuer by a aggrieved party. There can be a punishment for false statement. So the idea is not to scare you. The idea is to educate all the valuers who are on board with us today here that following valuation standards is extremely important. We are seeing regulators regulating professionals with the absolute strictness, and therefore it is important for us to make sure that we know and then act based on the knowledge of IVS. Coming to the next process, where we talk about the key updates in the latest version, and here the idea is to talk about in summary that what all is required to be discussed today. So one, we need to understand that the effective date for the latest IVS is 31st January 2022. But the IVS, the latest version, makes it very clear that one, that it says that they encourage the adoption of this version of IVS earlier than that date starting from any date from the date of publication. So therefore, I would advise that one can always say, oh, we are updated with respect to the latest IVS. We will give you the report based on the latest IVS. That will be, of course, something that everyone will understand and keep you in good books, that you keep your knowledge updated. And we will go forward and see and talk about what are the changes that are happened and that have happened, and how much do they affect us. Then coming to new chapters, so there is a new chapter called IVS 230, which is on inventory. And this is a very, very remarkable one, because in India, if we talk about valuations, then inventory is one item where the valuation can be anything. Most financial statements, most of our CC limits, OD limits are based on a number of inventory valuation that is there in the balance sheet. And that is a very, very important part of a balance sheet to be vetted. And it is good that IVS has dedicated one IVS on inventory, talking about the nitty-gritties of an inventory. And we will discuss more as we come to the inventory IVS. Then there are technical revisions. So IVS keeps doing it. It keeps giving out with the proposed revisions, gets the industry opinion on the same, and then finally goes out and then publishes the changes. Introduction has been revised to incorporate a new core principles of valuation standard setting and a core principle of valuation. So these are two core principles which are now being introduced in the IVS, and they talk about what are the principles that are adopted with respect to valuation, what are the principles that are required for valuation standard setting. And these two principles are in a way a value framework, a code of conduct that has now become part of IVS, and we will discuss about this at length as we go forward. International valuation standards are these. You start with an introduction, a glossary, an IVS framework. You talk about general standards. In general standards, you have a standard on scope of work, on investigations and compliance, on reporting, on basis of value, valuation approaches and methods. Then you have specific asset standards. So one asset standard is applicable to those valuations where the valuation involves where the assignment involves valuation of business and business interests. Then there are valuation of intangible assets, non-financial liabilities. Inventory, of course, is the new addition in this list. Plant and equipment, real property interest, development property, and then lastly, financial instruments. Coming to core principles of valuation standard setting, it says that the purpose of valuation standards is to promote and maintain a high level of public trust in valuation practice by establishing appropriate requirements for valuers. Then you talk about valuation standards, where you say valuation standards should be principle-based and adequately address the development of a credible opinion of value and the communication of that opinion. So please note, all valuers, that it is not only important to develop a credible opinion that somebody will like the computation that you have done, the approach that you have followed, and so on. It is also important to communicate that very well in your valuation report, so that any person who kind of reads that in your valuation report very simply understands without too much difficulty on what approach have you followed. Development and revisions of standards. So standards are to be created and revised when necessary by way of transparent process after appropriate exposure. So as I said, that they keep doing that, they keep the standards, share that for public review and feedback, and then process it. With respect to jurisdiction, the core principles of valuation standard setting is very clearly says that because these are international valuation standards, it allows the valuer to depart from the IVS and follow a departure or follow a law or a regulation that requires the valuer to do the job in a particular way. So the idea is that the local laws, regulatory frameworks, legislations, if they ever conflict with the standards, then you have to follow the local requirements or the legislative requirements. And not the international valuation standard. And of course, wherever you make a departure from the IVS due to legal grounds, you have to say that, yes, this is what you have done. You have departed from the legal process. and you have departed from the IVS to follow the local regulation and all that, and these are the deviations that you have made. This is what you need to disclose. Coming to core principles of valuation. So ethics, valuer must follow the ethical principles of integrity, objectivity, impartiality, confidentiality, competence, and professionalism. And competency, so it says at the time the valuation is submitted. So not anywhere before, anywhere after, but at the time of valuation submission date or valuation submission, you must have the technical skill and knowledge required to appropriately complete the valuation assignment. Then compliance, the valuers must disclose or report the published valuation standards used for the assignment and comply with those standards. Basis or standard of value, valuers must select the basis of value appropriate for the assignment and follow all applicable requirements. And the basis of value must be either defined or cited. What are the basis of values? Anyone who can tell me? What are the basis of value? Can somebody give me some examples of basis of value? You can unmute yourself, speak out. Anyone? Market value, liquidation value, equitable value, synergistic value, right? All that. So date of value, effective date or the date of valuation is the valuer must disclose or report the date of value that is the basis of their analysis, opinions or conclusions, and the valuer must state the date they disclose or report their valuation. So the valuation date is also important, and the date of in which the valuation is supposed to be valid, or the effective date, is also important. Assumptions and conditions. So valuers must disclose significant assumptions and conditions specific to the assignment that may affect the assignment result. Intended use. All of us understand that whenever we do a valuation, whenever somebody approaches us to do a valuation, the first thing we ask is, what do you need it for? What do you want to do with this valuation? Why do we ask that? Because based on that, our legal liability is there. Based on that, the valuation methodology might change. So therefore, intended use is important. Intended users are also important. Somebody tells you, I need a valuation report for my own purpose. I want to check how much should I pay for this, for acquiring this business. It is only for a consultative purpose. That's a different theory altogether. But somebody says, I want you to sign this valuation report, and I'm going to use this valuation report for the purpose of preparing this person's balance sheet under fair value. That becomes a different idea. So intended users are important, that who is going to eventually use the report, whether it is a banker, the statutory auditor, who is it going to be? Scope of work, valuers must determine, perform, and disclose or report a scope of work that is appropriate for the assignment that will result in a credible valuation. Identification of subject of valuation. So valuers must clearly identify what is being valued. Data, valuers must use appropriate information and data inputs in a clear and transparent manner. I always encourage all valuers to write down in their reports what are the documents that you have received from the client, what are the documents or information that you have sourced from public information, and talk about what information are you relying on. Okay. Record keeping. So valuers must keep a copy of the valuation and a record of the valuation work performed for an appropriate period after completion of the assignment. Can anyone tell me the requisite period which is written in our registered values and valuation rules with respect to the record keeping requirement?
3 years.
3 years, very good. So thank you, Mr. Jain, for answering that. 3 years is the time that is also recorded in the company's registered values and valuation rules. And we're not only talking about the valuation report or a copy thereof, we're also talking about all the people perhaps you have approached to find out market prices, whatever comparable data you have received, client data you have received at any point within 3 years from the date of valuation. As a registered valuer, you have to have all the documents to justify the valuation that you had given. Then basis of value, we talked about this, that fundamental principles of all the IV, all the basis of value have already been mentioned.
I'm checking up with Ankit ji why the sound is lost.
I think connection has been.
I'll check with him.
So he's back, sir.
I hope I'm audible. I think I lost my connection for
Exactly.
some
Yeah.
reason.
Yes,
And
please go ahead.
we'll just resume. So definitions added in the glossary, as I was saying, are definitions which are, or most of these definitions are already part of IVS. But yes, the idea is to have them as in the definition so that they are also applicable to all the IVSs. And whenever an IVS says basis of value, you can always go to the definition and say, okay, this is what it means. So similarly, costs have been defined, discount rate has been defined, equitable value has been defined, and rather these definitions, I should say, have not been defined, but have been added into the glossary. All these definitions that we're talking about. Then fair market value has been added into the glossary. The definition of fair market value has been mentioned as two possible fair market value definitions. One can be the OECD definition, the other can be the US Revenue Services or US IRS Services definition. Then there's a fair value definition under international financial reporting standards, and of course, Ind AS in India has also adopted the same definition. Then there is investment value, there is liquidation value, nothing new here, everything is the same. While I'm here, I should once again say the liquidation value definition as mentioned in the IVS may be different or is different from the liquidation value as defined in IBC. So be careful about how you're using the definition. Similarly, when you talk about fair value under IBC, say the fair value under IBC is very, very differently defined within IBC itself. So make sure you take a departure from the IVS in this situation and go forward with the valuation, the definition of the value or the premise of value stated in the act itself. Coming to market value, so the estimated amount and all this, the definition remains the same, no change, but yes, it is now part of the glossary. Then there is price, and that is what is again defined here as the monetary or other consideration asked, offered, or paid for an asset which may be different from the value. So yes, it also admits, IVS also admits, as we discussed in that webinar on Zomato valuation, that price can be different from value. Value is what you get, price is what you pay. Very, very old saying that all of you must have read multiple times. Then, of course, we have synergistic value, which is there. There is a change in the definition of valuation. So the valuation earlier was defined as a valuation refers to the act or process of determining an estimate of value of an asset or liability by applying IVS. What have they done now? Now they say the act or process of determining an opinion or conclusion of value of an asset on a stated basis of value at a specified date in compliance with IVS. So what have they done? They've said that earlier we were only talking about the act or process of determining an estimate of value of an asset or liability by applying IVS. But now we say, okay, applying IVS is a different thing, but that the valuation exercise that we are looking at here is supposed to be not only by applying IVS, but also in compliance with IVS. The second or the third thing that they add is that they say that the act or process of determining an opinion or conclusion of value of an asset or a stated basis. So they say it should be on a specified date in compliance with the IVS. So it is supposed to be on a stated basis of value. It is supposed to be on a specified date. Anyone who has any questions on why the valuation should be on a specified date? Valuation has to be on a specified date because if the date changes, maybe the valuation will change. Some valuations can change within hours. Some valuations can be the same for an year, for 2 years. You never know. So on a specified date is important. Stated basis of value is important. Today you tell me that, okay, you give me market value. I will then say, okay, the market value is defined in a particular way. And the market value, when it is defined in this manner, the way you see it on the screen, is supposed to be computed assuming that I don't have any synergies in the market. In the market, everyone is the same, everyone is there trying to trade something. And yes, if somebody is very, very eager to sell his business, or somebody is very, very eager to buy a business, then that eagerness will kind of not be there in the market, right? That might be there in individual transaction. So that market value is where everyone is very, very diligent. Everyone is, having a proper marketing, proper due diligence, etc., etc. But when I talk about an equitable value or a synergistic value, we're looking at very different definitions. So what is the value that will suit the purpose of the evaluation that is being conducted is important. If two people come to me and say, oh, we are having this company where we are joint venture holders or we are joint partners, and we want to split our business. One, this A wants to buy my share. Please value our share, value this business, or value this for us. At that point in time, I can't do a market value unless and until they give me that mandate. Most probably, I want to compute the value which is supposed to be entered into when those two people transact between each other, specifically with each other. So therefore, those values can be different. Then coming to the definition of value itself, the word value was defined earlier as value refers to judgment of the valuer of the estimated amount consistent with one of the basis of value set out in IVS 104 basis of value. Let us see what is the definition now. Now the definition has been changed to value is the opinion resulting from a valuation process that is compliant with IVS. It is an estimate of either the same, either the most probable monetary consideration for an interest in an asset, or the economic benefits of holding an interest in an asset on a stated basis of value. So there is a very, very interestingly new definition. The earlier one was, I should say, maybe more generic. This one seems to be more technical. The idea is that the opinion resulting from a valuation process that is compliant with IVS, that again they have covered up here, but then they say that it is the estimate of either the most probable monetary consideration for an interest in an asset or economic benefits of holding an asset. So these are the two things, right? One can say, oh, I will get a monetary consideration for this asset. Then that is what you will look at. The other person can say, oh, I will get economic benefits by holding this interest. Then that is what you are valuing. When you come to valuation approach, you say that in general, a way of estimating value that employs one or more specific valuation methods. So again, valuation approach, anyone can tell me a definition, an example of valuation approach? What can be the can be an example of valuation approach? Anyone?
Market approach, income approach.
Very well. So market approach, so market, income, cost, these are the three approaches that are mentioned in IVS. Anyone who can give me an example of valuation method?
Field method.
Yeah, replacement cost method, discounted cash method, all these are methods, right? So we have to learn. The first thing that any valuer needs to do is, in case not already there, I think most of you are answering very correctly, and therefore most of you are knowing the difference between the premise of value, the basis of value, the valuation approach, and the valuation method. These are four different concepts, four different ideas, and we should never mix up between them. Of course, there is always interdependency between them. One can derive the other, one can influence the other. But yes, they are different concepts, different understanding, and understanding needs to be taken care of with respect to all that. Then we come to a valuer. Now, a valuer, they had defined earlier as an individual or a group of individuals or a firm. Now they have changed that. They have said, we don't want to say that a valuer is a firm. We say, oh, or we will like the individual within an entity to be covered by this standard. And this is what they have talked about here. And then they say that regardless of whether employed or engaged, possessing the necessary qualifications, ability, and all that remains the same. But what you need to concentrate on is that one, it talks about individual within an entity. So it is not now the responsibility with respect to following IVS is not on the firm officially. It is officially on the individual within an entity on which the IVS is applied. Of course, the firm is also liable for all the actions of the partners involved. So regardless of whether employed or engaged, and in engaged, it also includes contracted or external. So basically it talks about both parts, where you have been given a valuation job as a contract by somebody, or somebody says that, okay, this is an external valuation. Otherwise they say, if I'm getting the valuation done within my entity for something, it is an internal valuation. Compliance with standards was the first para with which the IVS main body at IVS framework starts with. And here there are two new paras that have been added. And the second para that has been added is that in order for a valuation to be compliant with IVS, the valuer must comply with all the requirements contained within IVS. So they had stated this earlier also, but now they have stated it here as part of a separate para to give it emphasis that this is an important part of IVS, that you can't pick and choose text or pick and choose parts of the IVS and say that, oh, I have followed IVS. You have to follow the complete IVS. And of course, it says that it further clarifies in para 10.3 that a valuer can only depart from international valuation standards as described in section 60 of this framework, which talks about departures from the valuation IVS framework to meet the requirements of a local law or regulation, which is also called departures. Then asset and liabilities, when you define that, it had a definition earlier which used to say that the standards can be applied to the valuation of both assets and liabilities. And now they have further improved it. They say that you can also apply the standard to the valuation of present and future claims on assets and liabilities. What are present claims on assets and liabilities? So basically, if somebody says, oh, I have a claim on your asset or a liability, and subsequently it looks into how that can be taken care of, then this is what it looks into, where it says that the present and future claims on the asset and liability is also taken care of. This is also now part of assets and liabilities, and one can value. Then coming to valuer. So valuer has been defined as an individual, group of individuals, or a firm. I think this is the same part, but the idea is that this is also a change in the valuer definition here. And we also saw that there was a definition change in the definitions part. So the same thing has been added here. One more thing that has been added here is that possessing the necessary qualification, ability, and experience to undertake a valuation in objective, unbiased, ethical, and competent manners. They have added the word ethical. Now, ethically, you have to be right when you're doing a valuation. That's how the valuer has been defined. Coming to competence, so it used to say, the earlier definition used to say that the valuations must be prepared by having the appropriate technical skills, experience, knowledge of the subject, and all that. They've added this part where they've now said that the valuations must be prepared by an individual, group of individuals, or individual within an entity, regardless of whether employed, internal, possessing the necessary qualifications, ability, and experience to execute a valuation in objective, unbiased, ethical, and competent manner. Coming to the main standards, coming to scope of work, that is IVS 101, there have been a few changes here. So they have deleted this word engagement to make it more wide, and it may not be an engagement, they say, it might be an internal valuation, and even in that case, this is required to be taken care of. Then they have reworded a few things. So there are always this part of IVS which says that the standard intends to be applied on three parts. One is for valuers for their own employees. So the employees are also required to follow IVS so that their internal reports or internal review reports should also be based on the same. Then the valuations performed by valuers for clients other than their employers. So there, where you're engaged by somebody else, that is also covered. Then lastly, where you say that there are valuation reviews. So even reviews are to be covered by IVS. That is the message in scope of work. And here they have made some changes. So they said that we will no longer call this in-house valuations. We will say wherever somebody is employed, yes, the valuations are applicable. Wherever somebody is engaged by somebody else to take up a valuation work, a valuation contract, and so on, there also it is supposed to be taken care of. Basis of value, there are all these parts. The new thing then that has been introduced in basis of value is allocation of value. Now we'll come to allocation of value and see what have they added, what is the para that they've added. So they've added this 220, and 220.1 says that the allocation of value is the separate apportionment of value of an asset on an individual or component basis. And it says that when appropriating value, the allocation method must be consistent with the overall valuation premise basis, and valuers must follow any applicable legal or regulatory requirements, set out a clear and accurate description of the purpose and intended use of the allocation, consider the facts and circumstances such as the relevant characteristics of the item being apportioned, adopt appropriate methodologies in these circumstances. Then you talk about 105. In 105, we look at approaches and methods. Here there has been a minor change in the first para, that they have added this very prominently now, that one or more valuation approaches may be used in order to arrive at the value in accordance with the basis of value. Now, this was already part of the overall text in IVS, but they have brought this out in the beginning to give some emphasis to this, I believe. And we all should understand that there is always this possibility to follow more than one valuation approach. And of course, it has to be a process where you kind of look at it again after you've done this, after you have practiced multiple approaches, and find out which one is most suitable to the purpose of the evaluation, or which one is giving you most comfort as a valuer. And in case there are more than two approaches that you want to seriously consider, then you can always find a way of doing that. But most probably the idea from IVS that we can derive in general is that you should ideally choose one method which is giving you the maximum comfort. That should be the objective. Then coming to the idea that of course all valuations are based on economic principles of price equilibrium, anticipation of benefits, or substitution. And if you look closely, price equilibrium to market approach, anticipation of benefits corresponds to income approach, and substitution corresponds to cost approach. So no changes, but again a repetition here, that always try and follow these economic principles, and that will guide you towards the right valuations under all the three approaches. Then we talk about cash flow forecast. So the idea is that it says that it depends on the purpose of the valuation. It used to say of the valuation has now been removed to make it more wide and more generic for all the objectives that we had just read with respect to IVS being followed for various parts. Coming to IVS 200, which talks about valuation as a going concern, there have been significant changes in this IVS now, and these significant changes include a lot of text being added to try and define a business. Now, business is something which we will understand what they have done with respect to changing that definition. So they've said the definition of what constitutes a business may differ depending on the purpose of the evaluation. Then it says, but generally involves an organization or integrated collection of assets engaged in commercial, industrial, service, or investment activity. And it says generally a business would include more than one asset. For a single asset in which the valuation is dependent on employing additional assets, working together to generate economic activity that differs from the outputs that would be generated by the individual assets on their own. So this is what they say is a business. And they have, of course, removed the old definition of the business. Coming to the next part, that is individual intangible assets or a group of intangible assets might constitute a business but would nonetheless be the scope of work. So this is a caution. It says that whenever you look at a group of intangible assets, they may not constitute a business, but they might come into these if such assets generate economic activity that differs from the outputs that would be generated by individual assets. So when you look at intangible assets collectively, they say if they collectively are producing something very, very different, then the idea is to look at them from the lens of IVS 200 as well. Then you look at the commercial, industrial, service, or investment activity of the business may result in a greater economic activity then those assets would generate separately. And the excess value is often referred to as a going concern value. So I hope all of you understand that whenever you employ various assets in a business and try to get some value, you must be understanding that a going concern value is always higher than individual assets, because you've placed a system, you've invested in a system, you've put in all the parts in different things, and combined them, and you've tried to make them work together. And having a system working together, working with all the individual assets between each other, is the creation that many people want to pay more money for as compared to their individual asset values. Maybe to save time, maybe to save the opportunity cost of losing that and all that. So this excess value may constitute a separate asset under certain bases of value in certain situations. The absence of excess value does not automatically mean that the asset or group of assets does not constitute a business. So in addition, economically, substantially all the value of assets within a business may reside in a single asset. Businesses can take many legal forms, such as corporations, partnerships. We know that in India, we have so many forms. We have a sole proprietorship, we have an HUF, we have partnerships, we have LLPs, we have JVs, we have companies, we have various types of companies. So the idea is that they say that the business could take other forms, such as a division, branch, line of business, segment, cash generating unit, an asset group that can consist of parts of one or more legal entities. So anyone who can tell me what all businesses does ITC own? All of you would know ITC, right?
Cigarettes, hotels, paper board, stations.
So if somebody tells you value ITC, and if you want to do a DCF of ITC, will you put everything in one bucket, or you will try and understand individual business units of ITC? Maybe you will have no option. Maybe you will have no option.
Sum of parts, sir.
Sum of parts, right? So maybe you will look at individual businesses to the highest level possible for you to see, because in case you start going into individual brands being owned by ITC, then you will go into so many businesses. So many companies are very, very huge. Look at Reliance Industries Limited, the kind of businesses that they have. Maybe a lot of businesses of theirs are allied with each other and are interdependent, but still, if you look at their flow chart with respect to the level of businesses that they are having, it will result into a large number. So the idea is that when you're looking at a business, you're looking at a business. When you're looking at a company, you're looking at a company. So this is what they have tried to differentiate or clarified here, that the entity is not only important. You can't just say that, okay, I'm looking at a company, I want to look at the company's cash flows. You can also sometimes look at the company as maybe a conglomerate, maybe having different assets, maybe some non-operating assets, operating assets, and then maybe 1 businesses, 2 businesses, 10 businesses, 100 businesses, you can never say. Then coming to the next part, that is interest in a business. It says if you have securities in the business, what can be the securities in the business? It can be a share, it can be a debenture, it can be a preference share, an equity share, and so on. And it says that these interests in a business can also take many forms. And it says that to determine the value of a business interest, a valuer first should determine the value of the underlying business, and then look at how the security that somebody owns, what right does that security give to him, and what is the differentiation with respect to his right, that person's right, and other rights, right? There's some renumbering because of all these sections being added. Now this part remains the same as before, so we can skip it. This part is also simply renumbered. I'm just sharing that just to avoid confusion, that yes, these 20.3 and 20.4 used to be there, but all these have been renumbered to introduce these parts into the going concern definition. And I would strongly recommend all SFA valuers amongst us to go through these changes and incorporate them within your valuation report format, or the template that you normally use. Coming to the valuation standard on inventory, it's a new standard. Let's see what it says. So first of all, it says that it will apply to valuations of inventory and valuations within inventory component. What is inventory? Can anyone tell me? What is a unique feature of inventory that you have in mind when you think of inventory?
It is available for resale.
Maybe yes, it is available for resale, but it is, yes, maybe yes, I can say that it has been made for selling,
Yeah,
right?
sorry. Yeah, made
And
for
maybe it is made for selling. What else? Anyone else who can give me some traits of inventory? What is very unique about inventory? Or what is very unique about
Impairment
valuing
over
inventory?
time.
So it is valued at cost or market price, whichever is less.
That's the accounting treatment. Very well. That's an accountant speaking, I guess. That yes, the book value of the inventory is normally taken as that based on the accounting standards or Ind AS that we have. But what is the unique feature with respect to valuation of inventory? Because we are looking at it as valuers, right?
Impairment, sir. Impairment. Reduction in the value
Impairment.
over a period of time.
But inventory is normally not held for a long period of time, right, sir? How will you like to impair it? Because what is the inventory for a manufacturing unit? Maybe the inventory is just 5 days of stock, 5 days of raw material, or maybe 5 days of finished stock and 15 days of raw material. So what is the we normally can find that the inventory is not a very sticky inventory, right? It is a very, very fast moving item.
Inventory also is a raw materials.
Right, can be raw material. Yes, very well said. But then the idea is, what is so unique about that idea that it is raw material inventory? What can be very unique about it?
It's a current asset.
We have looked into the whichever is the present value of that. By the LIFO or FIFO method, adopting that, we have to come to arrive at what is the present value it can fetch.
Okay, so the idea is that you're looking at a valuation date, and on that valuation date, your inventory can be in any state. Your inventory can be finished goods, your inventory can be WIP, your inventory can be raw material, mostly. Then your inventory can also be stores and spares. What is the idea? What is the idea and the difficulty for a valuer in valuing is to find out that what is the value as on the valuation date. Because let's say somebody was manufacturing an iPhone, and while manufacturing that iPhone, suddenly the cutoff date came in, and that phone is now lying there. It still does not have a screen. It still does not have the box all fitted in. But yes, maybe most of the parts within the iPhone, or maybe most of the parts within the phone, I should say, are all there within the phone. And maybe somebody can say, oh, we have done 40% work in this phone to make this. So in that case, when you've done 40% of the work that was involved or that was required, you should ideally look at the value of that 40% of the work that has been done already. That is the value that you should be assigning. So look at more on all this. So inventory broadly includes goods which will be used in future production processes. So it says raw material, parts, supplies, then goods used in production process like work in process, and goods awaiting sale, that is finished goods. And it says that this standard focuses on valuation of inventory of physical goods that are not real property, as the numerous and varied aspects of real property inventory are not considered or contemplated in the preparation of the standard. What is a real property? Immovable property is called real property abroad, and maybe in IVS also, I should say. So real property, when it says that if you have inventory, within inventory, if you have a land and building asset, then can it be possible? It can very much be possible. A real estate developer can always have a project as its inventory, right? And the standard says that when you look at a real property, please go to our other standard. So 400 talks about real property interest, and 410 talks about developmental property. Both these properties then can be both these standards can then be approached. Now it says that it starts with the idea introduction towards the whole process, and it says that while the book value of the inventory only includes historical costs, the profits earned in the production process, which reflect returns on the asset utilized in manufacturing, including working capital, property, plant and equipment, and intangible assets, are not capitalized into book value. So as a result, the market value of inventory typically differs from and is usually higher than the book value of inventory. Then we look at this as inventory is seldom transacted at an interim stage. Example, on a work in progress process state, or may not be frequently sold to a third party to conduct the selling effort, the valuation techniques and considerations for inventory frequently vary from those of other assets. So what is the challenge? The challenge in inventory valuation is to try and estimate at what percentage of work has already been completed towards the inventory, and adding the value of that to the book value or the costs that are recognized by somebody. Then there is inventory valuations are performed for a variety of purposes. It is the valuer responsible to understand the purpose of the valuation, and they've given a non-exhaustive list. In financial reporting purposes, they say inventory can be required to be valued for business combination purposes, for asset acquisition and sales, for impairment analysis. Then it says for tax reporting purpose, inventory valuations are frequently needed for transfer pricing, analysis, estate and gift tax planning, and reporting and ad valorem taxation analysis. Then inventory valuations may be subject to litigation requiring valuation analysis in certain circumstances. Then valuers are also sometimes asked to value inventory as a part of general consulting, collateral lending, transactional support engagements, and insolvency. Basis of value, nothing new. Almost all standards, all asset-based standards or asset-specific standards have this very clearly written, that basis of value, go to 104, look at all the basis of value there and follow the process there of identifying the basis that is most appropriate to you, or the basis that are more appropriate to you. Coming to valuation approaches, it talks about that you can the method described below. It talks about how the various the methods that are defined here talk about multiple approaches and talk about how it is a mix of all these approaches, some place or the other. And it says that if necessary, the valuer to classify, if it is necessary for value to classify a method under one of the three approaches, the valuer should use judgment in making the determination and not necessarily rely on the classification below. So it says that yes, there is always a sometimes a mix of various approaches, and you kind of then look at all those and then take a final decision on what that is, what approach are you following and what method are you following. Then the market approach, reference to market activity involving identity. So coming to market approach, what do you do in approach? You look at the economic principle of price equilibrium. You say that if my inventory is valued at X rupees, then there is a very, very high chance that somebody else will also value the same at that price, or the other way around, I should say, is more appropriate, that if the market values something at a particular price or a particular value, then you can say that yes, the value that you will get will always be similar to that. So the market approach, reference to market activity involving identical or similar goods, it says has only narrow directive application for the valuation of inventory. Why does it say? Because it says that wherever there is a commoditized product, anyone who can give me an estimate, give me an example of a commoditized product? Gold, can I say gold is a commoditized product? Yeah. Yes. Can I say diamonds are commoditized?
Yes, oil, crude.
Partly yes, partly not. Yeah, some of them are, it totally depends on what. There's a rating, then each diamond is very different. But yes, maybe commoditized to a level. Then?
Crude is a commoditized.
Crude, yes, commoditized, right? So when you talk about commoditized items, do you think it is logical for you to say that if you want to value, say, the petrol or diesel lying with your company, or lying with the company where you have to do valuation, can you just not say, oh, the diesel and petrol today in the market fetches, is available at this price, and therefore I'm valuing it at this price, right? Because it is a commoditized price, a commoditized product. What will be different in that versus anything else? Then you look at inventory, in which a market exists for the inventory at an interim stage in the production process. So there, what can be the examples of this kind of an inventory? Anyone? Can I say molasses, something like that? It's a product that is an interim stage product, it can be, and it can be sold in the market. Anyone else who can tell me an example of an intermediate product, intermediate stage inventory?
Cotton yarn, sir.
Yeah, cotton yarn, cotton fabric is also an intermediate stage product where if somebody can say, oh, I'm making clothes out of the fabric directly. So if that person has some fabric left over, then one can always look at the commodity prices for fabric in the market, right?
Commodity prices like this one, sir. In pharma industry, ibuprofen-based intermediates coming from China and other places.
Yeah. So yes, very well said. So I think they call it something like ASR, right?
Yes.
Yeah. So that these are commoditized products where you have those chemicals and then you use those chemicals
for
to
the
make the products.
production of sugar. So
Sugar, what kind of
import.
intermediate product are you looking at, sir, in sugar?
The two stages.
Okay, so there's a market for the intermediate sugar item that is maybe a brown sugar or not so refined sugar. That's what you're saying?
Yeah, some they call it some syrup. They get this. Some industries prepare the syrup, and the two types of processes. In one type of the process, they'll buy the syrup and then convert it to the sugar.
Okay, all right, understood.
Starch for
right.
the.
Yeah. So these are some examples where we see that yes, there is a active market for these intermediaries or intermediate products, and we can use market approach to value inventories wherever you feel that yes, the market price equilibrium concept can be applied there, and nobody in the normal sense will give more price than the value at which this is available in the market itself. And then it says that for non-commodity traded price products or products that a market exists at an interim production stage, such selling prices must be adjusted downwards to account for the disposal effort and related profits. So whenever you look at inventory and you say, oh, my inventory is supposed to be sold in the market for 50 rupees, just next week it will be sold for 50 rupees. So let me just value it at 50 rupees. So the question is that no, maybe you shouldn't do that, because the profit within that sale price and the disposal effort that you're putting in is important. Then while the market approach is not directly applicable in most instances, valuers should consider market-based indications to determine the selling price as an input for other methods. So the idea is that wherever you're using other methods, you might have to come back to the market approach in economic sense wise and see, oh, what is the market price for this, and then use that for maybe a cost approach or something like that. So other observable markets may provide insight on the returns attributable to the manufacturing and disposition of assets that can also be leveraged for inputs into other methods, and such returns are typically considered to exclude returns attributable to intellectual property. So for example, distributor profit margins represent a meaningful market proxy for returns on the disposition process. And then contract manufacturers, to the extent available, may provide a proxy for margins earned through the manufacturing process. So this kind of example will help you understand that basically distributor profit margins, contract manufacturers will give you an insight of what kind of margins are expected in the sale of those products that you're valuing as inventory. Then values must comply with paras 20.2 and so on. So the idea is that IVS is structured in a manner that IVS 105 talks about the way a particular method is supposed to be looked at, and then a particular method is supposed to be chosen between the various approaches and methods that are available. And for that, it says that yes, you follow all that, go to IVS 105, read all that, and then take a decision based on that. The other part which is important is that it says that whenever you're applying market approach, you should use market approach only if the following two criteria are met. One is the information is available on arm's length transaction involving identical or similar inventory on near the valuation date, and sufficient information is available to allow the valuer to adjust for all significant differences between the subject inventory and those involved in the transactions. Where evidence of market price is available, valuers should make adjustments to those to reflect differences between the subject inventory and those involved in the transactions. So these adjustments are necessary to reflect the differentiating characteristics of the subject inventory and those involved in the transactions. So such adjustments may only be determinable at qualitative rather than quantitative level. However, the need for significant qualitative adjustments may indicate that another approach would be more appropriate rather than the market approach. Coming to income approach. So income approach, any questions on market approach from anyone? Any questions for anything that I've talked about so far? Okay, you can just unmute and ask in case you have any. I will proceed forward. Income approach. So the idea is that the valuation of inventory using the income approach requires the allocation of profit contributed pre-valuation date versus the profit contributed post-valuation date. So my valuers must comply with paras these. I don't think that's important. We will just read through all that also. This is the standard part. Then there is a top-down approach and income approach. The top-down approach is a residual method that begins with the estimated selling price and then deducts the remaining costs and estimated profits. So say you want to value the work in progress that is lying in your factory for a mobile phone. And you say, oh, this will sell in the market for this price. Then you will reduce the margin that you have to, the effort that you have to make to sell that phone. Then maybe you have to do other things. The idea is that the top-down approach starts with the estimated selling price and then keeps going down for all the work, all the costs, all the profits all the costs that are pending and the profits that are not even booked. So the top-down method attempts to bifurcate the effort and related value that were completed before the measurement date versus those efforts that are to be completed after the measurement date. The key steps are: you estimate the selling price, you estimate the cost to complete, you subtract the cost of disposal, you subtract the profit allowance on the completion effort, you consider any necessary holding costs and keep them and provide for them. This is the kind of effort or the process in a top-down approach that is followed. Then when determining cost to complete, cost of disposal and profit allowance, the valuer should identify and exclude any expenses that are intended to provide future economic benefits and are not necessarily to generate the current period revenue. An example of foreign future benefit expenses may include research and development related to new product development, marketing for a new product, recruiting to increase the size of the workforce, and so on. Then internally developed intangible assets should either be modeled as a cost as if they were hypothetically licensed and therefore included in either the cost of production or disposal, or considered as part of a functional apportionment when determining the appropriate profit allowance. So when utilizing the top-down approach, valuers should consider whether sufficient data is available, and only then they should apply this. And the valuer may use the bottom approach if to corroborate the value derived from the top-down approach. What is the bottom approach? In the bottom approach, you have the following key steps. So you determine the book value of the subject inventory first, then you add any cost of buying and holding already incurred, then add any cost towards completion already incurred, add the profit on total costs already incurred, and that's how you kind of value do a market value of the inventory. And when determining the costs already incurred, valuers should consider internally developed intangible assets that have contributed towards completion efforts. You must look at that. Then coming to cost approach, it says the primary method to value inventory is the replacement cost method. Raw material inventory is typically valued using the current replacement cost method. And then of course says that you can follow IVS 105 and do this complete job. And current replacement cost method, it says, may provide a good indication of market value if inventory is readily replaceable in a wholesale or retail market. That is what it says in the current replacement cost method. Then the market value of raw materials and other inventory may be similar to the net book value of the valuation date, but certain adjustments should be considered. What are these adjustments? The book value may need to be adjusted to FIFO basis. If raw material prices fluctuate or the inventory turnover is slow, the book value may need to be adjusted for changes in market prices. The book value of raw materials may also decrease to account for obsolete and defective goods. The book value may also need to be decreased for shrinkage, which is the difference between inventory listed in the accounting records and the actual inventory due to theft, damage, miscounting, incorrect units of measure, evaporation, etc. The book value may need to be increased for any costs incurred in connection with raw material preparation. The following sections address a non-exhaustive list of topics relevant to the valuation of inventory, identification of value-added processes and returns on intangible assets, relationship to other acquired assets, and obsolete inventory, unit of account. We will discuss all these one by one. Identification of value-added processes and returns on intangible assets. So the idea is that when you allocate the profit between the profit earned pre-measurement date and the profit earned post-measurement date, you can't just say, okay, I see that, okay, 90% of the cost has been incurred. Let me just add 90% of the profits to my profit, right? It might be a possibility that that 90% cost that has already been incurred did not have too much of an effort to earn the profit, right? So therefore, this is what it deals with, that whenever you look at any profit allocation, any adding any element, you must look at this part. Then valuers should distinguish between value-added costs and those that are not value-added. And the material portion of COGS may not be a value-added cost because it does not contribute any of the profits to the inventory. So for a company that owns internally developed intangible assets, they have to look at they see that yes, there is a contribution in the profitability from the intangible assets. Then they can check whether those intangible assets have already been used or they will be used after the valuation date. A valuer should determine the extent of to which the technology, trademark, customer relationship support, and all these have been part of the process to earn the revenue. Then for marketing intangibles, the determination of whether the intangible is an attribute of the inventory may be difficult. So to assist with the determination, the valuer may consider how the inventory would be marketed by market participants to its customers, pull versus push model. And a push model requires significant disposal effort for inventory and is less reliant on marketing intangibles, while a pull model depends on a strong brand development and recognition to pull customers to the product. So valuation profession is a push model or a pull model?
Pull model,
pull model. Mostly I would think it's a pull model. I don't think it's a push model where yes. A non-exhaustive list of other considerations for evaluating when intangible assets are contributed may include the amount of marketing spend, whether products are sold through a distributor, level of attrition of customer relationships, and so on. So these are all intangible related stuff that needs to be taken care of when you are doing the valuation for inventories. And then it says that in some cases, the intangible assets may consist of several elements that contribute to various aspects of the value creation, and such a pharmaceutical product, intangible asset, and all these examples have been given. Then it says single intangible asset may only contribute to either the manufacturing or disposal effort, and it is possible for a portion of the intangible to be contributed pre-measurement. And so the whole fight is pre-measurement, post-measurement date, and between that you have to create a balance. Coming to obsolete inventories, the valuer should account for obsolete inventory reserve balances, and the inventory reserve balances should be applied to inventory in which the reserve applies, rather than netting against the entire inventory balance. So typically, the obsolete inventory adjusted for the inventory reserve would not be valued as if it has been adjusted to net realizable value. So the idea is to adjust the two parts with each other. Unit of account. So the purpose of inventory valuation, it is often appropriate to assume inventory in one homogeneous set of assets. However, if it is possible for profit margins, risk, and intangible asset contributions to vary by product or group product group, then you can separate it. Any questions on inventory valuation standard?
So this inventory valuation is required to be done only in some special cases, not like that every year we have this audited account prepared. For that, this particular inventory valuation method is not applicable by a registered valuer.
Not even for India, I believe there is no requirement of that. You have to value it as cost or net present value, net realizable value. That is the definition. That is what you follow. That is a book value of inventory.
So a registered valuer will not be required to value the inventory every year.
A registered valuer might be required to value the inventory in case of an IBC case, where yes, on a valuation date, the inventory is required to be valued. And in that stage or in that case, it will not be wise for you to take care of net realizable value or cost, right? At that point in time, you might want to see that what are the other methods that are applicable to the process.
Correct. That's what I call the special requirement.
So somebody can also say that, okay, I want to buy this inventory from one company to the other. That might be a case. There might be certain inventory lying with somebody which there is a dispute on the net realizable value between the auditor and the company. Now, in that case, a valuer might come in. But of course, at that point in time, you will have to say that this valuation is being done to compute the fair value under Ind AS. And therefore, there is a deviation that is required from whatever is written here.
Yeah, my second question is, what are the intangible elements in the inventory?
It's not about intangible assets in the inventory. There is no intangible asset in the inventory, but the idea is that in case you say that, okay, I have, say, an intangible asset called my relationship with the supplier. Now, in case my relationship with the supplier is an intangible asset that I have, I need to check out that have I used my intangible asset to bring the inventory to the current stage. In case I have, then I have to take proportionate share of the profit and add it perhaps to my inventory value.
Okay.
Okay. So the idea is that when somebody says, oh, how do you value your inventory? And I say, oh, I evaluate inventory at cost. But here somebody says, oh, do you have a profit margin, or do you have, overhead cost allocation that you have done on this inventory? Or have you simply taken the cost of raw material as the value of the inventory? The normal answer would be that yes, we have taken proportionate value of the overheads that we have incurred in taking the inventory to the stage at which it was positioned or it was there on the evaluation date. And that is what we are trying to streamline and understand.
Yeah.
If some company holds the, is buying and selling brands,
okay,
or software licenses, will that amount to the intangible inventory?
Swimming club.
Yeah, it can be. So I think you're right in the sense that intangible inventory, that you can say that that's an inventory, but then the idea is that normally when you look at, say, a software under development, so a software under development will be an inventory for somebody who is making it to sell it to somebody else, and where the contract maybe says that, okay, he has to build the complete model and then sell it. However, I think that will be totally dependent on the the revenue model or the revenue model of the company. Now, in case a company is making a software to give it on cloud-based model, in that process it will be maybe a fixed asset only, right? It will never become an inventory. So maybe
even a house unit in case of a builder could be an inventory.
Yeah, why not? Yeah, that's the land and building is frequently an inventory. Yes.
What I'm saying is, where you are giving apps on tabs or cloud basis is a different thing. But let's say I buy 100 licenses of SAP and I have been authorized to sell, then it will amount to my intangible inventory.
It will be amounting to buying, and yeah, it will be an inventory for sure. And whether you can say it's an intangible inventory or tangible inventory, it is a license that you're owning. And I believe, yes, my sense says that you can easily say that these are intangible assets still, because these are just licenses that you are owning.
So
But
then
they are inventory.
in the balance sheet, it will be shown as inventory.
Yes, yes, very much.
And similar thing happens to carbon credits. The one who generates shows in the inventory, and one who buys it takes it into the non-current assets.
Carbon credits are meant to provide, is a mechanism to provide subsidy to those who are avoiding carbon emissions and all that. And the normal accounting process that I've understood is that you tend to either so maybe there are some carbon credits that you have which you are yet to sell in the market. Now,
Yeah,
for
in fact,
those,
I have dealt with this. Navin Florin, Wafatla Group, Surat. They generate the carbon credits and show in their inventory an intangible item. And the American companies or European companies who need to buy them, they buy it, and for them it becomes an intangible asset under non-current.
Got it. Got it. Can be certainly. I think you're right in the sense that yes, carbon credits can also be said to be intangibles, but I'm not sure. I think they're readily convertible into money, right? Aren't they kind of securities which are readily convertible into money?
There is a carbon credit market, no? So it is being bought and sold.
Yeah, but it is kind of a security, no?
No, not security. They are bought and sold, and they are generated.
So I'm just wondering in case they will also qualify as a monetary asset.
The inventory is itself not a monetary asset.
No, but I'm talking about carbon credits.
Carbon credits lie in inventory, which is not a monetary asset, and when they are sold, it's like a goods sold. Here is a inventory sold of the intangibles.
All right.
So will it be like TDR in the land and
transferable
building?
developmental rights is what you're talking about. TDR.
Similar to that.
TDR is again a license right, and it of course is an intangible asset. Whether you will recognize. So when you buy a TDR from somebody, of course it becomes part of your inventory, because then you're using and loading that TDR on your project, and then using that TDR to develop the project. So it becomes part of your inventory because it is going into the cost of the overall
if you are in the business of buying and selling TDRs or these assets, then only it becomes a part of your inventory. Otherwise, they just remain your intangible assets only. Yeah. If you are not in that business.
So if you're trading, in case you're trading in TDRs, of course, then of course TDR becomes your inventory, no doubt about it. But in case you're selling TDR to kind of liquidate your rights, maybe then also it will become an income. But I'm wondering in case so the only when we're looking at inventory per se, it will only be part of inventory when you're looking at TDR as a traded item.
No, you're right. I mean, to be frank, the simplest way of understanding is, will the revenue arising out of exchange of that? In that case, it will lie in inventory and go to cost of goods sold. Simple.
Yeah. So any other question on inventory?
No.
Okay, let's move on to real property interest. So real property interest, there has been a change in the introduction para. So this talks about property interests are normally defined by state or the law of individual jurisdictions that are not often regulated by national or and are often regulated by national or local legislation. And they've added this part where they said that in some instances, legitimate individual, communal, community, and collective rights over land and buildings are held in an informal, traditional, undocumented, and unregistered manner, and before undertaking a valuation and so on. So can you give me an example of this traditional, undocumented way of or unregistered manner of property ownership or rights over a land? In India, can you give me an example here in India where you don't have a document and then you can still say that this people or this community has a right over this land or this asset? Anyone? Sorry?
Inherent properties
an unregistered JDA?
I think in the tribal area, the tribals might have that those type of
Very
rights.
well said, Raji. Very well said. I was
It's
expecting
like
that
assigned
answer.
land, assigned
Yeah.
land
So
or
so
something
we
is
have
valid.
a system of giving tribals the rights. So forest dwellers and tribals, they have a right on their own land, and even if there is no property paper where they have bought something, they have the right to live and use the land and other nature assets, and they have a ownership, or they are compensated for this in case it is taken away from them. So that was one example of an informal traditional undocumented manner. Then there are other
Even
ways
the
of a patta.
encroachments could be another example.
Encroachments,
The
there is
encroachment,
no.
because subsequently any political party comes to power, it regularizes it.
Yeah.
So that it becomes their property subsequently.
But the idea is that it starts with the legitimate. So in case you talk about an encroachment, it is illegitimate till the time it is legalized, right? So we can't say that it is legitimate in any way.
Yeah, that's
the
true.
right. So you can
But
say
it
that
can
yes,
fall in the
maybe.
example.
So
Yeah.
till the time the rights are not legalized, I don't think you can say that there is a right which can be valued or which can be used by somebody to give a loan and so on, because it
Excuse
is
me, sir.
always challengeable.
What
Yes, sir?
about Waqf properties for use for the Muslim community?
What about what?
Waqf for properties.
Work
Waqf,
properties. Work
WAKF.
properties, I think there is
Is
a
it
very,
not used
very.
for Muslim community?
No,
No,
the idea, sir, is that we are just looking at examples here,
Yeah.
and I think the
work,
Waqf board and the properties
work,
owned by Waqf
work
board is
property
pretty
is a
well
donation.
documented.
Property is a donated
But
property.
but it's not informal, sir. It's a very formal system.
Waqf property is
It
basically
is also
trust form.
it is also very well documented.
Yes, it's trust form.
Yeah. So I don't think it will form part of this. Work property is a different concept. It is more of a concept where the property is held in trust,
Yes.
where somebody is managing it and somebody else is perhaps taking benefit out of it. And the idea is, of course, preservation also.
Deities of the temple will have the hold on the temple's land.
Okay. So the idea here is to understand this change, sir, and the change, I think we understand that is there. So in case
even without even if the documents are not there, the deities will be the owners.
Yeah, understood. The deities will be the owners, but again, when the deities are owners in India, I think when the deities are owners, they are also owners, and they, in a sense, that the trust or their ownership is managed through trustees. That whether the trustees can be the pujaris there or the management of the temple, right?
So many times there will not be a trust or trusts also.
Whether it is informal or formal doesn't matter, but I'm saying that normally because somebody is representing the owner, right? The owner can the owner is seldom
himself is the deity.
Understood, but the deity is not representing himself in any legal right or any transaction where the valuation is happening, right? The deity is all normally represented through somebody or through
sometimes some of the times the titles will not be there.
Understood. So yes, I understand that there might be a traditional way that this temple has been here for a long time, and there may not be a title there, and yes, therefore those rights that come to the temple from being where it is are mostly traditional and maybe also unregistered. Then coming to a real property interest, it says that the real property interest is a right of ownership, control, use or occupation of land and buildings. And it adds that a real property interest includes informal tenure rights for communal, community, and or collective or tribal land, and urban, rural, informal settlements or transition in economies, which can take the form of possession, occupation, and right to use. So it says wherever there is no legal title, don't worry. We understand, and they have now recognized the idea that if the real property interest includes some informal tenure right, then also you can say that yes, these are real properties and you can value them under IVS 400. Then they have made this minor modification. They said that yes, earlier they used to say that all these things should be stated in the valuation report or talked about in the investigation, and this nature and source of the information to be relied upon. Now they have said it is not must, it is should. So should changes things. Should would now mean that in case this is not applicable, you can simply say that yes, this is not applicable, and you can escape it. In a must, you have to do this for sure. So they have added this word if applicable against the evidence. So the evidence, if applicable, if available, required to verify the real property interest and any relevant related interests. Then it talks about responsibility for information on the site area, site characteristics, and building floor areas. So they have added site characteristics as part of the list here. Then they have again made minor modifications in this one, the way they have talked about the existence of any information on ground conditions, and it used to earlier say the existence of any information on ground and foundation conditions. Now it says ground conditions and soil conditions. So it has a wider impact now, because the foundation and the soil and the all that now is widely covered here. Then it of course talks about potential environmental factors instead of risks, because environmental risks are maybe a narrow part of environmental factors that can affect somebody. Somebody can say, no, this environmental factor is not a risk, it is only a factor. But the idea now is a wider ambit where all factors, all environmental factors are required to be taken part of this. So with this, I think I am in time, or almost on dot on time, when I say that yes, we are through with the presentation. These are the list of IVS changes in IVS that have happened. And maybe we can take some more questions before we wind up at 8:25 to stick with the program schedule. I've disabled the sharing. I can take up any question.
Great, Ankit, it was great.
Thank you, Nitinji. Any questions, any suggestions, any queries, any practical insights that you have on trouble that might be faced in following this IVS? Anyone who can share any opportunities that they see in the new IVS?
It was wonderful, Ankit ji. I think people have really got their ideas very clear about what happens in 2022, and that too in a very simple and nice way. Instead of my saying, even if you are able to see the chat box, it is full of praise for you. So it's like a third party.
I think I did not do much. I just so there are very, very good documents available on IVS. IVS also publishes a version of the new IVS wherein the changes are very, very clearly marked. So that is very helpful for anyone who wants to go through these changes as part of the overall text. And of course, I'm always available in case anyone has any doubts or has any practical issues in implementing the IVS. So over to you, and I think when we can, we are dot at 8:25, so we can take it forward. Thank you everyone for the patient hearing, and thank you all who interacted and made this a slightly interactive session. And thank you so much.
Timal ji, over to you. Timal Maru sir.
Yeah. Thank you, sir. Indeed, it's a great honor and privilege to propose vote of thanks on this knowledge sharing session. At the outset, on behalf of Association of Valuation Professional, I thanks our chief guest of the session, Ms. Deepa Gupta from Australia, who despite her busy schedule has found time to focus on this, grace the session. Thank you, Madam, for your very much interesting address on the Australian standard and comparison with the standards which is applicable through the global like USA. There are a lot of opportunity to come to various standard applicable on the various regions come to a closure with the IVS. Thank you, madam. Further, in India, if you see with the introduction of the Companies Act 2013 and regulatory changes, there are a lot of people who are inclined to come forward for the valuations opportunity, and most of the people are going forward for it. Now, when those people are going for the valuation assignments, they require to follow the standards. As rightly said by the Ms. Ankit ji, registered valuer is required to follow the standard either prescribed by the any agents, any registered valuation organizations or the IVS. In the today's session, Ankit ji has covered on the changes which is applicable from effective from 31st January 2022, specifically in case of new standard which is 230 inventory, which seems to give a lot of opportunity to the people in the valuation Second, he has also talked about IVS 400. With that, also he also spoke about the lot of changes in the definitions and glossaries. There is IVS framework changes. So there are a lot of changes which is going on, and valuation professional who are issuing the report after 31st January 2022 need to keep all this in mind. On behalf of Association of Valuation Professional, I thanks Shri Ankit Goyal ji for a great and valuable inputs on the changes in the or amendment in the IVS standard. I expressly heartiest thanks to today's speaker, Shri Ankit Goyal, for making excellent presentation and making this session interesting and meaningful. Thank you for your valuable contribution. We are really enlightened with your knowledge and presence. Also, I thank all the participants for making this session vibrant. Without your participation, this event would have not been successful. Last but not least, I would thank Sri Ram Bhavan sir, President of Association of Valuer Professional, Mr. Nitin Brahma, Head Resource Committee, Mr. Sandeep Agrawal, Head of Professional Development, our coordinators for today's session, Sri Murli Krishnan, Sri Prakash Mishra, for all effort put in for organizing or making this event a grand success. Thank you all. Over to you, sir.
Thank you for all attending here, and I can see here that people are waiting till the last minute, and we are very honored with a one-line request again to all to join AVP as a life member by just clicking your Google Pay or Paytm ID, and the details are already given to you. It's only one-time fee of 5,000. We already have 150 members, and lifelong you will get such knowledge sharing session at no cost once you start becoming a member. With this, I declare the session as concluded and request everybody to log out. Ankit ji, once again, thanks.
Thank you.
And I'm sure you will share the presentation on the group or send to us. Then we'll share with the participants. And with this, I request all to log out, and we will be concluding the session.
Thank you very much. Thank you, everyone. Thank you, everyone. It was a pleasure. Thank you.
Thank you very much.
Thank you, Bhavan sir.
Thank you, everybody, and all can log out, please. Ashu, you can end for all and then start recording.
শনিবার তোমরা কালকে বলছো না শনিবারে তোমার